In this video, we look at how Ethereum is ripping up and breaking the crypto rulebook and why this is important for your investment. If you're invested in ETH, we're going to go over all of the different aspects of the merge and how it is going to affect the value of Ethereum and your investment over time. So I'll leave all of the timestamps for the different video sections down in the description. We're going to get to the first timestamp though, which is why is this important? The Ethereum merge is important because money and profits. That's what everyone's chasing after all the time. And Ethereum is changing to become a better investment for investors. And that's why everyone's excited about this. Maybe too much. We're going to go through that in this video. Here's why the move to proof of stake is important for Ethereum. Right now, Ethereum pays out incentives and fees that go to miners. If you're a miner, you make money from mining Ethereum. Well, that is going out the window, and now Ethereum is getting rid of the miners, and it is going to be paying fees and incentives to us. If you're an investor and you have ETH and you stake ETH, you can make money from the protocol by investing in it, and some of the fees and incentives are going to go through Ethereum and they're going to go to us. This is why investors are getting excited about ETH, because they can get some of the protocol profits back to them. How much does Ethereum make though? Well, actually quite a lot of money. You can see here the Ethereum miner revenue chart monthly. They are making serious wedge. Ethereum, as you can see here, the miner revenue in the bull market was making a total of 2.4 billion up to maybe, 2.4 billion a month. Now in the bear market, you're making somewhere closer to maybe 300, 400, 500 million. It's still a lot of revenue that goes to miners. Well, those miners are getting chucked out of the network. And so that's why investors are obviously getting excited about this. This is a big event. Even exchanges, big exchanges are having kind of promotions around this. Binance is giving free Bitcoin and ETH trades right now. So is Bybit on all spot trading pairs. So free trading essentially. I'll leave some links to them in the description because you can get deposit bonuses on those as well. So click the links if you're new to either Binance or Bybit. They'll give you deposit bonuses and commission free trading, apparently only for a short period of time, I'm sure though. So the real big kicker really here is proof of stake is better for investors. Miners are kicked out of the equation. This differentiates Ethereum massively from Bitcoin. Now, Vitalik has come out with essentially an article here saying why he thinks proof of stake is the future. I'm not so sure. I think they both have a place in crypto, but here's what Vitalik has to say. He's worried about Bitcoin for two reasons. Bitcoin could face problems in the long term owing to its fee model. We'll get onto what that is. Bitcoin currently distributes coins to miners as payment for securing the network. Ethereum does this as well. But as the protocol has a hard supply cap of 21 million, eventually the network will rely on transaction fees alone for security. Bitcoin is not succeeding at getting the level of fee revenue required to secure what could be a multi-trillion-dollar ecosystem. This is according to the Ethereum founder. So obviously no surprises there why he would say this. Bitcoin averaged about $225,000 in fees over the past week, trailing DeFi even like Aave and Uniswap, which are only two protocols built on Ethereum. The biggest fee generator is Ethereum itself with 2.7 million over that same time frame. You can go on cryptofees.org or I think this is .info and actually see this. Ethereum makes more money than anything else. Now, if you're an investor and you're seeing that this is going to be passed back to you, then obviously investors are getting excited about this. Bitcoin is still profitable. I think we're still extremely early in this. It's far too early to say that Bitcoin can't grow its fee revenue from upgrades. But anyway, proof of work provides much less security per dollar spent on transaction fees than proof of stake. Vitalik argues that it would be problematic to have a $5 trillion network that costs only $5 billion to attack. This video isn't about proof of work versus proof of stake, but the facts are really clear. Ethereum makes a lot of money from its protocol, and it's about to return that to investors. Bitcoin has more than 100 years worth of issuance left to figure out a sustainable business model, and so I think that'll be fine too. Let's look at Ethereum tokenomics then and why people are getting excited about the merge. We can actually compare the merge to something like a Bitcoin halving. Bitcoin every 4 years or so goes through a halving where the new issuance of coins is reduced by half. That's why it's called a halving. And you can see each halving actually corresponds to a massive uptick in the price as the supply goes down and demand either stays the same or goes up, you obviously get a rise in price. Now, interesting here is that each halving does not get sold, right? You don't buy into the halving and sell the news. What's happened is actually you do get a run up, but as the halving comes, there's an extra run up as well, as the supply and demand is obviously changed. Less supply, same or more demand. So people are obviously saying that this may happen to Ethereum as well. The difference with Bitcoin is that the halving is very repeatable in a fashion around every 4 years. The Ethereum Merge is a kind of one-off event that will essentially make Ethereum real-time burn tokens and reduce supply dependent on how many people use it and pay fees. Let's go over to the Ethereum Merge then and actually see how that will play out. You can go to ultrasoundmoney.com. The Merge is happening around the 14th of September, give or take a day. Now, Bitcoin currently issues around 1.5% more coins every year as an incentive to miners. Ethereum also issues coins as an incentive to miners, but after the merge, that doesn't happen. At the moment, you can see that Ethereum has 4% more coins created out of nowhere every year that is given out to miners as an incentive. That is a weight on the price because all else being equal, your Ethereum is diluted by 4% every year. That's not good. Now, you need at least 4% or more demand to actually up the price. After the merge, you can see here that's taken out to be a supply of around flat, even possibly negative, because fees are used to burn buyback tokens and reduce the supply. So you're looking at a big halving, a 4% dilution every year down to 0% essentially. That is why people are interested in this, and it's not going to happen every 4 years like Bitcoin. This is a tick by tick, day by day burning based on how many fees the protocol earns per day. Is this important? Well, we can look at some other cryptos that are actually doing this already to see how they've reacted in price versus something like Bitcoin. Now, it's kind of difficult to compare this because you have much smaller coins. They're very small in market cap and size. They can grow very quickly, but the total terminal market cap and valuation is very different. So this is short term versus very, very long term. But what we can see is that Bitcoin versus Binance Coin, BNB chain, they burn tokens from fees, and it's done very well versus Bitcoin, even in a bear market. Why? Because people use that protocol for gaming and whatever, and they burn tokens. And so there is a structural buyer for the tokens, and that returns value to the token. It's done very well versus Bitcoin. Even Matic, to a lesser extent, it turned this on much later than BNB, but it's fared pretty well against Bitcoin. Now remember, we're in a bear market, and these tokens are gaining value versus BTC. This is over the short term, and long-term valuations obviously are a different thing. So a lot of the hype out there is that people think ETH is going to the moon and it's just going to go up forever because fees are going to be used to pay back investors. Well, yes and no. A profitable business is going to go up in value, given there aren't any other problems. But companies buy back their shares all of the time. It's not new. Apple buys back shares, Cisco System, ExxonMobil, they buy back shares, but they're not worth tens of trillions of dollars. Something like gold is, though, and silver. So there's a difference in valuations between companies which have management and products that eventually suffer from competition and get eroded, the margins get eroded away, and something like a commodity like gold, which can just accrue value over the long term into the tens of trillions of dollars. It's very important to understand this dynamic, for me anyway. You can see something like Cisco Systems, they do a share buyback, which is essentially what the token burn is, and they're worth around the same as Ethereum, around 200 billion. The question for me is, are investors over the long term going to treat Ethereum like a currency or a commodity which can accrue much more value than something like a company who has its platform eroded away by competition over the long term? Every company has a point where it gets overtaken by something else. And as we know, Ethereum has competition from Solana, Cardano, Avalanche, BNB chain, and many others. So whilst this is great and value accretive for investors, over the long term, we must also look at how dominant ETH can be over the long term for its platform in order to actually support growth in the price. Ethereum profit margins are going to get squeezed over time. The developers are specifically trying to lower their own profit margins for the Ethereum protocol. We know that layer 2s are going to scale Ethereum. The merge doesn't do that. Layer 2s like Arbitrum, Optimism, ZK technology from Polygon will reduce fees dramatically. We can see that post EIP 4844, which is an upgrade, L1 data fees will be reduced by orders of magnitude. Yield out of ETH will reduce over time, but that's very, very normal for any asset. Yield gets reduced as an asset matures and the risk goes down. So it's not a bad thing, but it's important to really be clear that the current narrative that ETH is this producing asset that you're going to be able to retire on, it's a normal asset that has high margins now because it's youthful. Over time, margins will be compressed by competition and the general way that the market occurs with reducing yield in assets that are mature. There is a misconception going around that after the merge, a ton of ETH that has been staked for the merge will get unlocked. That isn't the case. Also, because of liquid staking derivatives, most people that need liquidity can actually get that right now if they want. And so there will be no massive unlock straight after the event. In fact, ETH itself, if you are staking with a validator and have 32 ETH, that won't unlock for I think around 6 months, but there's a schedule to unlock it that will take a long time. In any case, most investors that are invested in the ETH 2.0 merge are actually using liquid staking derivatives or using exchanges that give you those as well. Lido is without a doubt the most popular. You can see that 95% of staked ETH, that is the ETH 4, ETH 2.0, belongs to small wallets with under 100 staked ETH. Vast majority of holders use staked ETH for direct staking and passive holding. This is a liquid staking derivative, meaning that if someone actually wants to sell, they can do so right now and switch it into ETH or USDC or something like that. And so there's absolutely no need to sell or dump tokens directly after the merge unless there is some short-term traders that are doing that anyway, but we would have to assume that that would be cancelled out by other institutions that just want to go long considering the merge was successful. So if you go down here, you can see that most people that have staked ETH as a liquid staking derivative are actually long-term passive holders who hold for quite a long time. They don't need to wait for the merge to sell out. This is a liquid staking product that can be sold right now. And so there is no issue for me with the merge having a big dump from ETH that is unlocking. That's just not true. Also, if you have Ethereum in a wallet or an exchange, then some specific tips of the merge. You don't have to do anything. As you can see from Ledger here, who provide wallets, your ETH assets will remain on their accounts throughout the merge. You don't need to take any action. Never share your 24 words. We strongly don't recommend transacting while the merge is taking place. So during those few days, they recommend not to try and go through with any transactions. So if you need to trade something or move something around, do it before the merge, because there will be a lot of disruption actually when the merge takes place. On the day of the merge, Ledger Live will pause Ethereum services directly on the app. But if you're sending ETH or NFTs around, that is going to be paused for a while from Ledger anyway, and it's going to be the same with other networks. For example, exchanges like Binance and Bybit will actually stop withdrawals for a while once they upgrade. There's a lot of hype around the merge, most of it warranted, some of it not, in my opinion. The merge is a good step to return value to investors, but for me, the long-term success of Ethereum relies on it being able to have a solid, secure ecosystem that remains the dominant platform that people want to transact on. There's a lot of competition and a lot of value that's going to be created outside of Ethereum as well, but this is a good step to create more value for investors, which is why people are getting excited about it. If you want to get commission-free trades over the short term on Bybit and Binance and those deposit bonuses, I'll leave those links in the description for you. I'm James, this is Money's EG. Cheers for watching, and I'll see you in the next one.